What's happening, guys? So I didn't think I ever needed to make a video like this, but it needs to be addressed. For a brief moment at the end of 2020, it looked like first home buyers were finally going to get a break. For the first time in a long time, the share of first home buyer loans was higher than investor loans. Now, weirdly enough, we've got COVID to thank for that. The economic uncertainty caused by the pandemic meant that investors were too afraid to buy property. It was a glorious and hopeful time, even though we're still in the midst of a pandemic. But that time's over and we're back to where we started. Let me ask you, does this sound like a familiar scenario? A young family's been at an auction for a home to live in. They're using every last cent they have towards the deposit of their dream home. Then, a buyer's agent in a flash Mercedes whispers into a phone and outbids them. They're forced out and off to try their luck at the next auction. The investor on the other end of the line adds a new home to the other dozen in the portfolio, and it's a scenario that's unfortunately been repeated across the country as investors flock back towards the market, driven by easy access to credit and skyrocketing property prices. And in fact, overall, COVID has made it worse for millennials. So in this video, let's talk about the current housing crisis and potential future direction of the property market. Whether or not it's a smart idea to wait it out to buy your first home, or why now could be the right time to buy for you. And I'll give you my opinion on what I think the government should be doing about it. But before we get into that, it would help me out a ton if you could hit that like button. Let's jump in. All right, first, let's take a look at the good times. What's helped first home buyers overtake the investors? The answer is it's been a combination of a few things. First, the government stimulus. The federal government's home builder scheme allowed first home buyers to access additional funds and increase property demand. At the same time, investors were slowing down and pulling back. In the lead up to COVID-19, investors were already leaving the market, creating a bit of a space for first home buyers to purchase homes. And with economists predicting a drop in home prices of up to 30%, it didn't look like a smart time to invest in property. After all, the purpose of investing is to make money, not lose it. And since international borders were closed, investors were concerned about rental demand. Zero immigration means fewer renters, which means vacancy rates, something that doesn't help you make a return on your investment. So what changed? Well, the property market did not go the way the economists were predicting. Rather than prices dropping, we're seeing unprecedented growth in the property market. So investors are coming back in droves, and who can blame them? The average price home in Sydney went up 13.5% in the last 12 months. If property prices continue to rise that fast, property prices will be double every 5.5 years. It's a pretty attractive prospect if you're looking to build your wealth. But it's not good news for first home buyers. Economists are now calling for the Australian government to intervene because the housing market is spiraling out of control. But why didn't the government intervene anyway? Yeah, in a sense, they did intervene. There was JobKeeper payments, mortgage deferrals, and the home builder grant were all introduced to help soften the blow to the economy. And I'm not saying they shouldn't have done this. It was 100% necessary and helped Australians weather the difficult times that we've seen through the past 18 months. But in a certain sense, you might have said they've done their job a little too well. I think now's the time they should be taking action to slow down the growth in the property market to give first home buyers a fighting chance. But there's not much evidence that's going to happen anytime soon. It's not because they can't do anything, it's just because they don't have the guts to do it. Just have a look at New Zealand. In May 2021, New Zealand's central bank slapped restrictions on the housing markets. Investors are now unable to get finance for more than 60% of the value of an investment property. They need a 40% deposit. And that definitely would take the wind out of the sails of investors and give millennials a chance to secure a property market if they did a similar thing here. But we're due for a federal election sometime in the next 6 to 8 months. And considering what happened to Labor in the last election when they tried to chop out negative gearing, if you don't remember, they got flogged. I doubt that ScoMo or the federal government's going to do much to curb the flow of investors in the property market.
Can everyone get off the grass, please? Sure, let's just move back from there.
According to ANZ senior economist Felicity Emmett, the Australian Prudential Regulation Authority, or APRA for short, is apparently using a soft touch approach to tame the housing market. APRA have written to the banks to question them about their lending standards to make sure they're lending responsibly, which basically means they're thinking about intervening in the market to slow things down, but they're not quite ready to pull the trigger yet. I think they need to push a bit harder. They should be implementing measures to curb investment loans like in New Zealand has done to support first home buyers. It's pretty straightforward. But now that we've covered that, let's take a look at how COVID has made the property market harder for millennials. As you'd expect, demands for homes during the COVID lockdowns declined. In March to April 2020, which coincided with the onset of stage 2 restrictions nationally, the volume of sales fell 39% across the country. Now, usually a drop in demand would see a drop in prices if the supply of properties remained the same. But new listings also declined. For example, new listings fell 44% in April 2020. So there were less properties to buy, which meant higher prices. And even as restrictions had eased, property demand has gone up. The number of listings remained actually lower, which is one of the reasons why property has gotten even more expensive. But what about the effect of lockdowns? Now, as you'd expect, property sales decreased during lockdowns. After all, it's harder to get out and go and check out a property or do anything else, really, when you're mid-lockdown. But what we've seen is that there's a massive rebound after lockdown's over. Sales actually jumped above normal levels once restrictions eased. So it hasn't really slowed down the market. Like you can see in this chart, the average weekly auction volumes were around 805 pre-COVID. During the lockdown restrictions, these dropped to 207. But with all the pent-up demand and the people sitting at home looking at listings, they went to 1,156 at the start of June when the lockdowns eased. Ultimately, lockdowns were followed by catch-up periods for purchases. In fact, in 2020 to 2021, CoreLogic estimates that there are approximately 582,900 transactions nationally compared to the decade average of 455,356. This is the highest annual sales volume observed since February 2004. Not just that, lockdowns actually made it easier to save. For example, houses saved 22% of income through June 2020 compared to the decade average of 7%. Overall, without COVID, house and unit prices would have been lower. According to a recent report by KPMG, house prices are now between 4 to 12% higher on average nationwide than they would have been if we'd stayed normal. And unit prices are 13% higher. It's insane. Ultimately, the COVID-19 price premium has widened the housing gap between the haves and the have-nots. Those who own a home are getting richer, and those who don't are getting left further behind even more. The average loan size for first home buyers is now $465,000, up from $355,000 in 2017. That's an increase of just under $100,000 in 4 years. So if you're feeling like you're fighting an uphill battle to save enough deposit, you're absolutely right. So what's going to happen in the future? You're probably wondering, what does this mean for you if you currently don't own a home? Is the market going to slow down enough for you to catch up, or will you be renting forever? KPMG says that soaring house price growth will temper over the next 2 years as mortgage rates rise and the fundamentals of the housing market begin to restart themselves. But economists have been wrong in the past, as we've seen in the last 12 months. What's going to happen is really going to depend on whether APRA or the Reserve Bank decide to intervene, or if they continue to let things run rampant. If the growth continues, it's only going to attract more investors. While owner-occupiers are turned off by higher prices or can't afford them, skyrocketing property prices make property investment even more attractive than it already was. Not many other investments can match a 13% annual growth rate. So investors are going to look to move their money from lower yielding assets to property. If the government does intervene, then we should see house price growth slowing. But what does this mean to you? My advice is this: if you've got enough money for a deposit, then I'd recommend getting into the market sooner rather than later. In the short term, it looks like house prices may continue to go up. If you don't have enough money for a deposit, do what you can to save up. It's going to be hard to keep pace with the current rising property prices, but save what you can. Remember that there's the First Home Super Saver Scheme to help you get there. There's also the First Home Loan Deposit Scheme to help you get into the market with as little as 5% deposit. We have a couple other videos on that, so check them out below. And remember, if you have any questions, hit us up on our Facebook group, the Home for Home Buyers across Australia. And if you're looking for finance and need a loan, we help people from around Australia. Hit us up at huntergalloway.com.au.